Hi there. As we come to the end of the year, I'd like to thank you for taking your time to watch my videos and for your comments and likes. I commit to continuing to improve your all-round experience and hopefully exceed your highest expectations. And now, on to today's episode. Recently, Ben Bernanke, the former chair of the Federal Reserve, was awarded the 2022 Nobel Prize in Economic Sciences. He shared it with two other recipients, Douglas Diamond and Philip Dybvig. They were awarded for their pioneering research into the foundations of modern banking. According to the citation on the website of the Nobel Prize, and I quote, "What is the role of banks in the economy and society? What happens if they collapse?" The foundations of modern banking research were laid by Ben Bernanke, Douglas Diamond, and Philip Dybvig in the early 1980s. Through statistical analysis and historical source research, Bernanke demonstrated how failing banks played a decisive role in the global depression of the 1930s. Bernanke's research shows that bank crises can potentially have catastrophic consequences. This insight illustrates the importance of well-functioning bank regulation. End quote. One frightening aspect of potential bank failure, which can at times be the harbinger of bad tidings, is the bank run. So, what is a bank run and why is it scary? This is the subject of our discussion today, which is part 2 of the series on financial intermediation. Part 1 focused on the economics of banking. I've included a link to the video up here. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. Banking is based on confidence and trust. Depositors deposit their money into a bank because they have confidence and trust that not only will their money be safe, but it will also be available, at least in theory, on demand. As I indicated in part 1 of this series, the economics of banking, banks make money and can pay depositors interest, not because they are good-hearted, but because they lend out the money depositors have deposited into their banks and charge interest for this. In practice, banks lend out a large proportion of the depositors' money deposited with them, on the theory that depositors are unlikely to want to withdraw their money all at once, and then also not in a coordinated manner. However, to ensure that banks are not tempted to lend out too much and subsequently find themselves in a liquidity crisis, central banks impose reserve requirements on banks, under which they are required to maintain a regulated percentage of reserves. This is the banking model used in most of the world. According to Wikipedia, and I quote, "Under fractional reserve banking, banks retain only a fraction of their demand deposits as cash. The remainder is invested in securities and loans, whose terms are typically longer than the demand deposits, resulting in an asset-liability mismatch. No bank has enough reserves on hand to cope with all deposits being taken out at once." Diamond and Dybvig developed an influential model to explain why bank runs occur and why banks issued deposits that are more liquid than their assets. The Diamond-Dybvig model provides an example of an economic game with more than one Nash equilibrium, where it is logical for individual depositors to engage in a bank run once they suspect one might start, even though that run will cause the bank to collapse. End quote. The Nash equilibrium is named after mathematician Dr. John Nash, who is the only person to win both the Nobel Prize in Economic Sciences and the Abel Prize, which is broadly recognized as the Mathematics Nobel, since there is no Nobel Prize in mathematics. His life, particularly his struggles with mental illness, were immortalized in the movie A Beautiful Mind. If you would like to know more about game theory, I've included links to 2 of my videos on the subject up here. Fractional reserve banking works well if only a few depositors withdraw at once, which is what usually occurs. But what happens when all the depositors in a bank, or at least a big proportion of them, suddenly decide they want their money all at the same time? Then you've got a run on the bank. In the first instance, the bank may rely on its reserves to potentially weather the initial run on the bank. The next step is to raise additional liquidity on the interbank lending market, including liquidating its loans at a loss, and finally approach the central bank, or the central bank may act of its own accord, which is the lender of last resort. According to Wikipedia, and I quote, "A bank run can occur even when started by a false story. Even depositors who know the story is false will have an incentive to withdraw if they suspect other depositors will believe the story. The story becomes a self-fulfilling prophecy. Indeed, Robert K. Merton, who coined the term self-fulfilling prophecy, mentioned bank runs as a prime example of the concept in his book Social Theory and Social Structure. Mervyn King, governor of the Bank of England, once noted that it may not be rational to start a bank run, but it is rational to participate in one once it had started." End quote. I've included a link up here on my video on cognitive biases, of which the self-fulfilling prophecy is one. Bank runs are scary and dangerous to a financial system and the whole economy because they can be contagious. They can start at one bank and spread to other banks and eventually create a financial crisis and potentially economy-wide catastrophe. What can the central bank and other financial regulators do to prevent or mitigate runs on banks? There are 2 main strategies implemented by regulators. 1, deposit insurance, where depositors' deposits are protected up to a certain limit. 2, capital reserve requirements imposed under the international Basel III requirements. These are designed to reduce the possibility that participating banks may become insolvent. In recent times, after the great financial crisis of 2007-2008, regulators are required to conduct regular stress tests to test each bank's resiliency under stressful conditions. The phenomenon of bank runs is as old as the banking system. In more recent times, Ben Bernanke has argued that much of the economic ruin of the Great Depression was caused by bank runs. During the Great Financial Crisis, the financial international system experienced symptoms akin to bank runs. In a European Central Bank working paper titled Savings, Efficiency and the Nature of Bank Runs, Agnesi Leonello and others write, and I quote, "Banks and their health are important for economic outcomes, and they have attracted a great deal of attention in policy and academic debates over the years. Banks' reliance on short-term debt as a source of funding has been considered a key source of fragility. Noteworthy is the unprecedented increase in total deposits that banks experienced at the start of the COVID-19 crisis. Figure 1 illustrates the evolution of total bank deposits in the last years for the US and the Euro area. They experienced a remarkable jump in the first months of 2020. From January to May 2020, bank deposits increased by around $2 trillion in the US and 1.5 trillion euros in the Euro area. In light of this fact, two questions naturally arise. Do more deposits affect bank fragility? If so, do agents correctly internalize this effect when deciding how much to save? In this paper, we address these two questions through the lens of a bank run model augmented with a consumption saving decision. We show that the level of deposits has an effect on the probability of a bank run." End quote. The paper goes on to conclude, and I quote, "The design of the optimal policy depends on the nature of bank runs, namely on whether banks are subject to panic or fundamental-driven runs. In particular, the former leads to undersaving, which can be corrected with a subsidy on deposits. The latter leads to oversaving, which requires a tax on deposits. Our results show that intermediaries that are not facing the risk of panic runs tend to grow excessively large, provide an inefficient level of liquidity, and are too fragile. This further suggests that prudential policies should be complemented by other interventions meant to reduce the incentives of depositors to oversave. In this respect, our paper highlights an additional potential drawback associated with bank guarantees. Deposit insurance and emergency liquidity provision by central banks may also distort savers' incentives and translate into an excessively large and fragile financial sector." End quote. I've included a video up here on a related topic, the marginal propensity to consume. On a related theme, in a paper titled "The Right and Duty of Central Banks to Issue Retail Digital Currency," published in a collection titled "Central Bank Digital Currency, Considerations, Projects, Outlook," by the Center for Economic Policy Research, Corinne Zellweger-Gutnecht puts it this way, and I quote, "Precisely because it is ideal money, cash also serves as a quality anchor for privately issued money, particularly commercial bank deposits. From a legal perspective, such deposits are claims denominated in state money and payable on demand. The resulting convertibility into state money means that they all circulate at par at an exchange rate of 1-to-1, despite having been issued by different banks with balance sheets that differ significantly in quality. Of course, prudential regulation and financial safety nets, such as deposit insurance, lender of last resort, and sometimes even bailouts, also help to keep the value of bank deposits uniform among themselves. Cash disciplines the banks, for if they conduct business with excessive risk, they will have to reckon with increased cash withdrawals. The insolvency of Lehman Brothers 2008 is a telling example of this. Because customers no longer knew which bank was still safe, they withdrew vast amounts of cash. The Deutsche Bundesbank alone, Germany's central bank, had to issue as many 500 euro notes in a single month as it would have otherwise done in an entire year. End quote. Before I end this discussion, I want to talk about bank runs in relation to central bank digital currencies. A general theme seems to be that the introduction of a CBDC may exacerbate the potential for runs on banks. Todd Keister and Cyril Monet, on the other hand, while acknowledging this possibility, nevertheless identify a positive aspect. In their paper titled Information, Privacy, and Central Bank Digital Currency, published in the same collection mentioned before, say this, and I quote, "In Keister and Monet 2021, we focus on one type of information a central bank may be able to infer from CBDC flows, the confidence depositors and other creditors have in their banks. In periods of financial stress, banks and other financial intermediaries have private information about both the quality of their assets and the willingness of their depositors and short-term creditors to continue to provide funding. A bank that is in a weak funding position will often have an incentive to hide this fact from regulators, at least for a while, to avoid triggering supervisory action. This combination of banks' private information and the incentive structure thus causes a delay in policymakers' response to an incipient financial crisis. Such a delay can increase both the likelihood of a full-blown crisis and the severity of such an event. Once a CBDC is introduced, in contrast, the central bank has a new source of information, the flow of funds into this digital currency. We show that the central bank can use data on inflows into the CBDC to more quickly infer the state of the financial system and perhaps of individual institutions. This new information allows the central bank to respond more quickly to emerging problems. One commonly raised concern is that by providing investors with a convenient, safe alternative asset, introducing a CBDC will make runs on the banking system more likely. This effect is present in our paper, but we show it is offset by the quicker policy response that a CBDC enables. When depositors and other short-term creditors know that the central bank will respond more quickly to an incipient crisis, they have less incentive to withdraw from their banks in the first place. In other words, the ability of the central bank to infer information about depositor confidence has the effect of increasing depositor confidence in equilibrium. In this way, the information a central bank would gain from using a CBDC can increase the stability of the financial system. End quote. For more on central bank digital currency, I have included a link up here